3, 2, 1.
All right.
I might have to come up with a different intro one day. It's just too easy
Different
to do
from
that.
3, 2, 1.
Yeah. I mean, I started doing that because I literally started every class off at our CrossFit gym with 3, 2, 1,
Right.
go. And
Yeah.
it's just in my mind, I'm like, that just gets you ready to go.
That is what it does.
All right.
All right, let's
what
go.
you got, man?
A bunch of things to talk about today. It's been an interesting week. It was all about inflation with CPI and PPI, which kind of leads me into my first slide. But anyway, we're going to look at pretty interesting article that came out about potentially repealing the tax that we would pay on Social Security benefits. So we'll talk about that. A couple different really important countries are now in recession. We found out this week. We'll take a look at new highs versus new lows. So how can we figure out if the market is looking toppy based on looking at the list of stocks that are making new highs versus the list that are making new lows? And we had a request to go back to bonus charts. So once in a while we'll do that. And Apple is going to be this week's bonus chart. And then we'll take a look at the C fund. So before we get to that, I got a little bit of a rant. It just annoys me. So
Just
Friday,
a little one?
it's just a little one. But Friday, the Dow. This is the headline from this article in CNBC. It's probably still be up there by the time we post this, but it's basically the one that keeps running on CNBC, and it just keeps updating. So Friday, this is Saturday morning, so this is over the weekend. But the headline was Dow slides 100 points on Friday, major averages end 5-week winning streak. Okay, so all three of the major averages broke their 5-week winning streak. This week, S&P ended lower by 0.42%. Dow was down. Dow is the Dow Jones Industrial Average, not the Dow Jones U.S. Total Market Composite, whatever it is.
Otherwise known as the S fund.
Otherwise known as the S fund.
A lot of people get that mistaken.
Yep. So when they say Dow, they mean Dow Jones Industrial Average is not the S fund. Dow is down. NASDAQ's down. So PPI comes out on Friday. Okay, so PPI is a measure of wholesale inflation, increased 0.3%. Economists had anticipated 0.1%. So it increased, meaning wholesale inflation increased more than what was expected. 10-year Treasury yield spikes, which is bad for the F fund, following that hot PPI reading. So at one point, the 2-year Treasury was up at 4.7%, highest since December. So it's been a roller coaster week for stocks, investors carefully assessing the direction of the U.S. economy and when the Federal Reserve may decide to lower rates. So on Tuesday, the Dow posted its biggest daily decline in nearly a year after the CPI reading came in at 3.1, which was higher than the 2.9 expected. That was the CPI and the PPI. CPI comes out on Tuesday at 8:30 in the morning. Okay. The market tanked at the open, which is what we would expect, because they had an hour to figure out to react basically to that CPI reading. So Tuesday's a big down day. Then the market shook off the report over the next 2 days. Right, S&P rebounds on Thursday to close at yet another record high. But Friday's wholesale inflation report, which also comes out at 8:30 in the morning, okay. They're saying Friday's wholesale inflation report added to concerns that the Fed may have to wait until later in the year before it starts to cut rates. I would absolutely agree that I think I called it a rate tantrum or a market tantrum or whatever on Tuesday. You know, the market gaps down, keeps going lower into the close. Absolutely just a temper tantrum about we wanted rates to be cut by March. They're not going to get cut by March. And then possibly PPI pushes that back to, June, July, possibly. But Tuesdays make sense because the report comes out at 8:30 in the morning. The market has an hour to figure it out, and it gaps down. Friday PPI comes out at 8:30 also, okay? We had a tick down at 8:30. So this is a 1-hour chart of the S&P. So CPI on Tuesday at 9:30 in the morning, the market opens way down. Okay, had this big gap down, which makes sense because, like I said, they have an hour to figure out kind of how to respond to that CPI number. On Tuesday, the market doesn't really start falling until 2 o'clock in the afternoon. Right? This is the open. It did come down a little bit, at the open, but then recovered in the next hour to new all-time highs. If we had closed at the end of that hour, so at 2 o'clock, if we had closed there, we would have basically been right at the prior all-time closing high. But it rolled over at 2 o'clock, and I cannot understand why. I mean, so it doesn't take the market until 2 in the afternoon to figure out that PPI is going to push rates further into the year. So if you looked at that on a 1-minute chart, it happened at like 2 o'clock on the nose. It just drops, and I can't find what happened. I don't know if it's algorithmic trading or what, but it clearly was not a response directly to the PPI report like the CPI was, right? Yeah. So the rant piece of this, to me, it's annoying because when you read the stuff in the media, like that article, it's not really accurate. Wednesday is accurate, right?
Right.
Because it responded to the report at 8:30, but the PPI report, for the market not to roll over until 2 in the afternoon,
that doesn't match up with what was going on.
No.
Yeah. And it is probably something like algorithmic trading. There's some sort of, something institutionally, whatever, something with a large enough impact to make that happen that may or may not have been driven by.
Yeah, the PPI report earlier. Yeah. So it annoyed, what annoyed me about it was how it was written in the article, and I'm like, this is not the same as Wednesday.
Right,
you can't just lump them both together.
Well, if it's not sensational, it doesn't sell any papers, man. So they got to make it seem a little crazy, but
I don't know. It basically makes me wonder like what exactly it was, because I'm hunting something different, and I can't find it yet. That's all.
Well, you didn't used to really care why.
Yeah, well, that's true.
Now we care mostly for the viewers because they want to know why. So we try to dig that stuff up. But at the end of the day, I mean, I distinctly remember one of the key things when we first started early on, we were like, kind of doesn't matter. Doesn't matter why. Price just did it.
Yeah. At the end of the day, that is true.
Yeah. But it is nice to know why, because then that falls into being able to forecast better, to be prepared for things like that. So,
well, if they say that the reason was PPI, and it was actually something else.
Right. That's just disingenuous.
I'd just like to know what that something else was.
Yeah, right. I don't think they know.
Yeah. All right. Repeal Social Security tax. This is pretty interesting. So myfederalretirement.com, that's the article if you want to read it. I didn't pull out the whole thing. There's some other interesting things in there, but HR 7804. It's called the You Earned It, You Keep It Act. Yeah. So 2 Democratic representatives sponsored new legislation last month that would repeal the federal tax on Social Security benefits starting in 2025. So we wouldn't have to pay tax on Social Security benefits. The growing number of those getting hit by the tax is due to fixed income thresholds. Unlike federal income tax brackets, the income brackets that subject Social Security benefits to taxation have not been adjusted for inflation since the tax became effective in 1984. Pretty interesting. So over time, more older taxpayers become liable for the tax on Social Security benefits, and the portion of taxable benefits can increase as retirement income grows. So, okay, they're looking at how to watch out for older retired people that are counting on Social Security benefits. So they're looking to pass this HR 7804 Act that would repeal the federal taxation on Social Security benefits starting in 25. The bill aims to directly benefit middle-class retirees without impacting their monthly benefits. Okay, so how would they do this? The bill would be paid for by raising the cap on Social Security payroll tax, so higher-earning Americans continue to pay into Social Security. This is the thing that has been boggling my mind for quite a while. I don't remember what the cap is because it incrementally goes up, but it was like, I think when I first started paying attention to it, it was 106,000, and I think it might be up to 120,000. I don't remember, but there's a cap. So basically, if you remember, if you make more than, I think back when I first looked, it was 106,000. So as soon as I ticked over 106,000 in salary that year, my pay would go up the next 2 weeks until the end of the year, because which was somewhere around November. So I didn't get the benefit too long, but it was kind of good for the last couple of paydays going into the end of the year because I didn't pay Social Security tax after I had made 106,000, right? Um, but it seems to me that if at least a part of the Social Security reform should be that you would pay Social Security taxes on everything you make. Like, why would you stop?
Why would there be a cap? Yeah.
Why would right? I mean, if you make 300 grand, why are you only paying Social Security tax on the first 120 grand?
Yeah. Yeah. I'm not a Social Security expert, so this stuff is like something I'd like to get a little bit more, up on.
Yeah.
But the thought is, well, you're not getting back. Once you draw Social Security, you're also not getting any more than you would have put in. So you didn't put in for that other 200,000 you were making.
Right.
So theoretically, you shouldn't be getting anything for that too.
Well, there's
so
an income cap too in
Yeah.
retirements because you're not getting all your Social Security if you make more than X,
Right.
whatever it is. And so, I mean,
This is where financial planners come in handy because they
Yeah.
have ways of like putting all this in one, um, all in one place, all the tax considerations, all the Social Security versus this versus that, your income, and telling you, hey, look, you don't want to make more than this, or if you make more than this, it doesn't matter. And those are the things that are hard to like take one thing, Social Security, and like base your decision off of this one little metric when really you should be basing it off, okay, well, college planning and, all of that. And that's where I'm in favor of financial planners because they're really the only people that get it. Financial advisors, investment advisors don't do that.
Right.
We don't care about that stuff. We don't care about all those circumstances.
Right.
A financial planner does. And that's why you really need one. It's because they can help you figure out what impact that particular
that one thing has on
will
you
have
for
on
sure.
it.
Yeah. I was looking at it more from I heard a couple of different things on C-SPAN this week about Social Security Trust Fund. Basically, in 10 years, the way the CBO projects it, in 10 years, if all things staying the way they are, there's an in the law, there's an automatic 23% across the board cut in Social Security. And so that will get people fired up. If you lose a quarter of your Social Security benefit, that'll get people starting to get fired up. But for right now, I mean, politically, I don't think everybody is saying that, your Social Security is safe and we're going to do whatever we need to do to make sure it stays that way and all that.
That's always the party line, no matter what party it is.
Right, it doesn't matter. And which basically means we're not going to fix it. We know we have this problem, but no one's willing to fix it means there's some kind of austerity, right? Somebody's going to have to take a little bit of pain along the way to fix it. And they're I don't think they'll the fix will be to add more tax to younger people, right? Employees, basically, because retirees can't, you have no way to fund an additional tax. But the cap on payroll tax, I always thought was an easy one, and apparently they're going after it in this act. So the same analysis showed that you earned it, you keep it, would also reduce the federal debt. Now, how you can reduce the federal debt by, $9 trillion over 75 years, I guess, you can project out 75 years. I have no idea. But how you're going to reduce the federal debt and at the same time...
That's that high math that we don't do.
Yeah, I mean, I didn't read the act, but I might go back and look at it just to see where you're going to get these savings so that you're reducing the debt by almost $10 trillion, even over 75 years. I mean, I thought that was interesting. So maybe we stop paying taxes on Social Security benefits starting in 2025. Let's hope. Okay. Recessions around the world. So if you guys, I've talked about Sven quite a bit. I've tracked pretty much everything he talks about. He's a really, really good analyst. His pinned post on Twitter, he's got this document that he produced kind of at the end of last year, beginning of this year, and it talks about, it's a very bullish, actually, interpretation, and he doesn't like it because it's bullish. He thinks everything should be rolling over, but the data is showing that 2024 could be rocky, but probably higher, and 2025 should explode to the upside. One of the things he has in there, which I thought was really interesting, is if you go back to like 1900, I think he did, every year that is a 5 year in the decade. So 1905, 1915, right? All the way every 5 year. Every single one of them is positive. Through all the World War I, World War II, oil embargoes, like everything that's gone on, if you look at it, every 5 year is positive and usually extremely positive. So that the trend certainly is that the 5 year, next year, 2025, should be a really good year. There are also a lot of people calling for 25 to be the really bad year. So we'll see how it plays out. It's still too early in 24 to talk about that, but interesting. So this week, Japan goes into recession. UK goes into recession. China and Germany are both hurting for different reasons. China's real estate market is wrecked, and Germany's manufacturing is in big trouble. Jeff Bezos dumps $4 billion in Amazon stock, and Buffett is reducing his position in Apple. So Sven, kind of being snarky about it, he's saying in retail, meaning like us little guys, ODTE, 1 day till expiration. That's what that means. So 1 day till expiration, chase every vertical tech play we can find. So people are buying options on this new thing that's 1 day to expiration. So if you think, options expire tomorrow, and you think that the market is going to go one way or the other based on options expiration, you basically bet. It's a casino.
It's 100% gambling. So.
Yeah, but it screws up the whole options chain.
It will.
Right?
It'll mess things up if a lot of retail. I mean, this is how the crazy stock. Shoot, I forgot the name of the company that they did this with.
Not AMD.
No. Yeah, it was the retail store. And everybody went and bought it because it was tanking.
Yeah.
I know everybody is listening to this going,
movies.
Is yelling.
It's the movie.
No. It was
AMC movies.
That was one of them, but there was the GameStop. Yeah, I was like, I knew I had it right on top of my brain. I haven't had enough coffee yet. I need some more Dunkin' in my life. So this is very similar, right? You can, and I'm sure he's not trying to make something like that happen, but you could also say something kind of like that, and then a lot of people on social media decide to go do it, and it will have some impact.
Yeah,
1,000%. And if you're not familiar with options trading, I mean, like it's very complicated to wrap your head around sometimes, but it's actually a great way to trade without having a lot of your money on the line. But it is essentially gambling for sure.
Yeah.
Now you can make educated gambling decisions for sure, like everybody does in the market. But it is gambling, so it's not something. That's also why a lot of companies will not let new retail investors won't even let them trade options. Yeah. You have to have a certain amount of money. It's nothing really. The bar isn't really high, but it's high enough that they basically want to make sure you know what you're doing before they let you trade options. I mean, we recently just started kind of playing with them for various reasons, but it is a way to short things without putting a lot of money on the table. Mm-hmm. But anyway, I mean, what this guy's saying, and I'll pull it back up on the screen, is just go out there and do this. And you will screw with the mechanism.
Yeah, it does. What his point here of the whole post is that, hey, Japan's in recession, UK's in recession, China and Germany are in trouble, Bezos is dumping Amazon, Buffett's selling Apple, but the little guy is gambling on every vertical tech play we can find, like SMCI. We're talking about that. SMCI is kind of like NVIDIA. It had this parabolic move to the upside. And over the last week and a half or so, but then on Friday it was down 20%.
Yeah.
So if you had just gotten on the bandwagon with it, and you're like, oh, I'm early, I'm in the first few weeks.
Yeah.
And you bought it at the top tick on Friday, you lost 20% in a couple hours.
Yeah. I mean, we find ourselves that way sometimes. I mean, I always tell people if you're going to play with things like that, there's nothing wrong with it, as long as you're only putting enough on the line, just like you would if you were going to the blackjack table and you don't have a gambling problem, right? So that's a disclaimer. You don't have a gambling problem. You go to the blackjack table and you're like, all right, I'm going to bet, $100. And if I lose that $100, I can still eat tonight. Yeah. That's the same kind of thought process process you need to have if you go chasing these kind of crazy stocks. I mean, I've jumped on a couple in the past few weeks. Again, just kind of for a lot of times for me, it's kind of testing an algorithm, and I like testing it with real money instead of like paper money. Paper money being like a fake money account, which you can do because there's a little more skin in the game, even if it's just a few $100. But I like doing it that way, and and you start to learn some. So again, as Jerry pointed out, if you're very savvy with your technical analysis and you happen to be watching one of these and you have your own little, personal algorithm, whatever you want to, say, you certainly could have taken advantage of one of those, but you certainly could have, like, if you don't know what you're doing and you jump on the bandwagon because everybody else is, guess what? You're going to be that person that sold it when it dropped 20% because you're not going to know to get out. You don't know why you got in the first place, right? You got to know why you're going in and you got to know when to get out.
That's
know when to hold them.
Yeah, I know when to fold them. Yeah, it's the value of technical analysis because at some point, if you watch SMCI, it'll come down to a certain level and find some support somewhere, and it'll break out from that. And if you're watching it and you see it get support at whatever level it is, trend line, moving average line, you'll see RSI and MACD start to turn back up, and that's when you would want to buy it.
Right. And then the opposite of when you want to get out. Right. That's the thing. I mean, and I'm still learning with that stuff, right? Even after following you for years, is trying to figure out, for me, a lot of times I feel like I have a good hang of getting in, but not so much of getting out. Like having that next line be a hard line. It's always kind of fuzzy for me, and I would say that over the years that I've known you, you're very good at getting out. Yeah.
Yeah. Getting out. I'm much better at getting out than getting in. But
that has a lot to do with I don't want to lose money.
Yeah.
Because you're doing it with a lot of money. I'm doing it with a few $100, at least in these learning situations.
Anyway, what he's saying here is the world is falling apart, is what that means, and us retail guys are running to the casinos to buy every vertical tech going company we can find. So kind of a bifurcated market. All right, so how do we use new highs and new lows to kind of take a look at this? So the top one is new highs of the New York Stock Exchange. Okay, so all the stocks traded in the New York Stock Exchange. It's a daily chart, and down here is the daily chart of the S&P 500. Okay, so this is just the number of stocks that are making new highs on any given day. So just because the numbers are low down here, all that means is there weren't a lot of new stocks that made new highs that day. Okay, so don't kind of get it confused with a trend of because the number is low here doesn't mean that the number of new lows is increasing. This is only new highs. Okay, so what the value of it is over time, as the S&P moves higher, you would expect the trend of new highs in companies to continue higher, right? And when the trend starts to decline, we're getting to a top, right? It's like you have to slow the car down before it starts going backwards. You're going forward in the car, you put the brakes on, the car has to slow down before it can stop and then start going backwards, right? And you can see that in the new highs. The number of companies making new highs. So in a healthy market, you got a general increase in the number of companies making new highs over time as price is going up. And then as the new highs decreases, it's telling you that fewer and fewer companies are adding to this price increase. So it's telling you a top is coming. And where we are right now, basically, like these lines are the same time. So we had a peak in new highs, and then it fell off a cliff, even though price was still going up. And that's what led us into that correction that we had fourth quarter of last year. And so where we are right now, the new highs list peaked back in December, right? And so it's not, even though we've had this big price move in January and February, companies are not making new highs. The new highs list is decreasing as price is moving higher. So that's one of the indicators that we're getting closer to a top. So it doesn't mean run out to the G fund tomorrow. It just means to expect that the next significant move of this thing is down, not up.
Right.
It's not-
We call it a bolo. Be on
Yeah,
the lookout.
be on the lookout. Yeah. So be on the lookout for a topping, a place you should be thinking about, okay, when am I getting out? When am I going to move to the G fund? As opposed to down here, you're thinking about when am I moving to the stock funds, which is basically this one. This is another way to look at it. So the last chart was from TradingView. This one's from Stock Charts, and it shows the information in a little bit different way. So the green on top is when companies are making new highs, okay? And the red is when companies are making new lows. So the interesting thing about this is you got that low that we had in June of 2022, and we had a ton of companies making new lows. And then we get a recovery in price, right? A pretty weak one because we didn't have, where we had a lot of companies making new highs back here. This is a pretty weak recovery. Okay, so this definitely called this rally into question because we didn't get a big explosion to the upside, right? In companies, basically this price move came on very few companies making new highs. But the deepest low in companies making new lows happened in June. Even though price got lower in October, the number of companies making new lows didn't, it was less. So it's a bullish divergence, right? You got fewer companies making new lows, even though price is continuing down. So you're looking for a bottom, right? That's what that's telling you. And so where we are right now, you got that peak in December, and the number of companies making new highs is going down. We don't have a lot making new lows, but if price is going to keep going higher, you need this line to be going in the other direction. So it's just a different way to look at the data, but it's the same idea. We should be looking for a top in the market. I don't know what the timeline. This doesn't tell you the timeline. It's telling you to what to anticipate next. Okay, Apple. So we got that Warren Buffett is selling Apple. JC just came out and said he's shorting Apple and Microsoft. And we talk about divergences and stuff all the time, and you can kind of see it here. So 2022, end of 2021 was the peak in Apple, which it also was for most of the NASDAQ, most of the stock market. Apple did get above that peak, but it hasn't really been able to, it's been churning right at that level, right? The problem is you got declining relative strength, CCI not so much, but not great, and MACD clearly declining. Since the peak back here in, June or July. So Apple hasn't really been doing very well, certainly in 24 and for the second half of 23. It's struggling, and it's one of the Magnificent Seven. And where it is right now, I mean, if we get a firm break below that 50 level, especially if we get below this low in price, Apple's headed down. And there's a lot of people looking at Apple and some of the other Magnificent Seven, mostly because if Apple does roll over, it's the biggest contributor to the S&P 500. So if it rolls over, we know, we've been talking about for a long time, the Magnificent Seven is what's holding up the market. If they roll over, the market rolls over. So all this stuff is kind of sort of coming together to show a top in progress. All right, C-Fund chart. So I got a weekly and a daily. So we have had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 16 weeks. Out of the last 16 weeks, so 4 months, we've had 2 down weeks, including this week, which it was down 0.42%. An unbelievable run for the S&P 500. On a weekly basis, we're overbought, right? Because RSI is above 70, but it can stay there. On the weekly, it can stay there for a while. You got MACD still expanding to the upside. So there's nothing on a weekly basis that is telling you that you should sell the C fund on a weekly basis. The trend is extremely strong. you could draw a trend line like that. You could use the 20-week moving average. It's a pretty big fall. At this point, on a percentage basis, you'd lose quite a bit if you took that drawdown and hoped for support at the 20-week moving average line before you decided to get out, which is the one downside of using weekly charts instead of daily. But for right now, there's no doubt about it. That trend is going in the right direction, and there's nothing in the indicators that would say that now would be a time to get out. This could be the top. We don't know. You never know until the top happens and you can observe it. And right now, it's still going higher. On a daily basis, it looks a little bit different, right? RSI peaked back here, and since February or January, end of January, we definitely have a declining RSI, and this does not look good right there. So on a daily basis, we could get a pullback, but every time we've gotten a pullback to that 20-day moving average line, it keeps getting support there. So until it breaks that 20-day, the trend obviously is up. I mean, that would be the first indication. Okay. I lost the whole thing. Am I back?
Yeah, you are.
Okay. The first indication is that RSI is rolling over, right? And MACD has turned negative on Friday. It's been flat the last couple of days, but it turned negative on Friday. So if price gets down here below that 20-day moving average line on the daily, it's an indication that something certainly has changed. Yeah, but for 16 weeks from back here at the end of October, we've basically gone straight up. And the trend is still in that direction. So don't let all the outside stories talk about, even the things that we just talked about. There are definitely reasons to be concerned, but until price actually changes the trend is still going up. Okay. If you want to get more in-depth day-to-day, hit us up at growmytsp.com. Questions?
Yeah, and so as Jerry pointed out, like the difference between what you guys see here on the show and what we have, in our weekly newsletter that goes out to all our subscribers is a lot more in depth, right? So we just covered the C fund. Well, of course, we cover all the other funds because, right now we're in part of one fund and part of another, and there's reasons behind that, right? And so a lot of times it's very difficult to be able to figure out the overall market might be going up, but it's even harder to try to figure out which fund might be outperforming the other one.
Yep.
And so that can get tricky, and then a lot of times it's a little bit of a gamble either way, whether you get it right. But to figure out those kind of things, you do have to get more in-depth analysis, and that's what we have on our site, for our customers every day and every Sunday. We put out basically it's an analysis report. We call it a newsletter that covers all that stuff, and it gives you everything you need to know to make your decisions for the next week.
Yep.
All right, if you guys have any questions, please get them to us so you can put them in the comment section wherever you find this video, or you can shoot us an email at support@growmytsp.com, and the support team will get it over to us. And I hope you guys have a great week, and we're going to go enjoy a little bit of snow we got today here in Northern Virginia.
That's right. All right, out of here.
See you guys.